right, hello and welcome to another At Wealth Partners event. My name is Tiffany Dawson, Financial Advice Associate from At Wealth. Today's event is titled Diversification Reimagined, where alternatives fit in today's market. Before we get started, a quick disclaimer on our next page. What's covered today is not personal advice. It is general in nature and should not be taken as a recommendation. Now, I'll tell you a bit about how today's session is going to run on our next slide here with the housekeeping. If you've got any questions, please use the Q&A box in the Zoom menu to submit a question privately. You can do this at any time during the presentation, and our speakers will get to as many questions as we can at the end. We'll also send out a recording afterwards, so don't feel like you need to take all the notes right now. You will have a copy to have a look at afterwards, and you can also send this to friends and family. Now, there's been a lot of noise in the headlines around alternative investments recently. So luckily today we've got two special guests to speak about this topic, which can be a bit confusing to some, or maybe some of you just want to learn a little bit more. So our investment team are here working day on day with our expert partners to make sure our clients get the right outcomes. Today, we're going to hear from a couple of speakers, but firstly, we've got Sarah Gonzales, our Chief Investment Officer at Wealth. She will discuss the alternative investments with you and then have a Q&A session with special guest Kyle McCarthy from PIMCO. Sarah is very well known to a lot of our At Wealth clients. As Chief Investment Officer, she provides portfolio construction solutions for advisors and their clients, and she manages the At Wealth Partners portfolios together with her team. Over to you, Sarah.
Thank you, Tiffany, and good morning, everyone, and thank you for joining what hopefully will be the first of a few sessions on alternative investments. As Tiffany mentioned, I'll run through just an outline of alternatives, what they are, and the different types of alternatives. And then in the second portion of the webinar, we are very lucky to have Kyle McCarthy from PIMCO with us today, and we'll be running more of a Q&A session in that second half. And so we would like to keep it very interactive. So if you have any questions along the way, please put them in the chat box, and then we should hopefully get around to answering those questions. So looking at alternatives. So what are alternative investments? Alternative investments are assets that really sit outside your traditional assets. And thinking of traditional assets, we're thinking about shares, bonds, and cash. They are typically used to improve portfolio diversification, provide access to different sources of returns, and they also use to manage risk within portfolios. And so looking at the differences between traditional and alternative investments, as I mentioned, traditional investments, we're looking at, the shares, bonds, and cash. Traditional investments are typically highly liquid. You can easily buy and sell them. Most of them are, particularly equities, are traded on an exchange. Whereas alternative investments may potentially have lower liquidity, and often long-term investments and are restricted in terms of the access to those funds within those alternative investments. Oops, sorry. The next one is traditional investments are typically daily market priced. So you'll get a price for those investments on a daily basis, whereas alternative investments may not be daily. It's more periodic, and sometimes it depends on when the assets are valued. Sometimes it's monthly, quarterly, sometimes even yearly. In traditional investments, you may experience higher levels of volatility because it is daily priced. And so you will see movements in the price more frequently, as opposed to your alternative investments, as I mentioned, because it's not priced may not be priced daily. You won't see those big moves in the price of the underlying fund or the underlying assets as frequently as you do traditional investments. Uh, Traditional investments are typically public market assets as opposed to alternatives, where alternatives can use public markets, but it also encompasses private assets, which I'll run through in this session. In terms of traditional investments, they do have a high correlation to investment markets, whereas alternative investments don't. And for traditional investments, returns are primarily driven by the overall market moves. If you think about your equities, it will typically follow what is generally happening in the equity markets, whereas in alternative investments, they're primarily driven by other factors other than what's happening in the market. And so looking at the different types of alternative investments, as you can see in the graph here, there's a few different ones, which I'll run through. So the first one, which is probably very common to a lot of you, is private equity. And this is really an investment in a private company and is not listed on a public exchange. And so if you think about in Australia, there's a lot of private companies that we have that's not listed on the ASX. That's what we think of in terms of the types of companies that private equity funds and investors are investing into. And particularly in private equity, there's different types. A lot of you might be familiar with, for example, venture capital, which is more your early stage startups with potentially higher growth. There's also growth equity, where this is more mature companies looking to expand or restructure. Or leveraged buyout is another very common one, where established company is acquired and leveraged is used or debt is used to really improve the profitability and then potentially exiting that investment. The next one is private debt, which we will focus on in the second half of this webinar. And private debt is really lending outside of traditional banking. So if you think about your Commonwealth Bank, ANZ, they do provide lending services to customers, businesses, companies, but this also happens outside of the banking sector, and that's what we call private debt. They're typically called non-bank lenders. And as I mentioned, they do provide loans just like banks do to customers, businesses and corporates, which Carl will go through in more detail. The next one is hedge funds. This is your pooled investment structures that invest in a whole range of different strategies to really try and achieve an active return while minimizing the level of volatility through different market conditions. And so they can actually invest in both traditional and alternative investments. The next one is real estate. A lot of us will be probably very common with real estate. What we're talking about is unlisted property. So this is direct ownership of, may it be a commercial property, an industrial property. So you're holding that particular building or property directly. And typically it provides you access to more specialized areas. So you do have your traditional retail, commercial and industrial sectors, but it does provide access to more specialized, for example, healthcare, hotels and resorts, and even social housing, for example. The next one is commodities. So commodities can be split up into your hard and soft commodities. So if we're thinking about hard commodities, this is your gold, your oil, your copper, for example. And your soft commodities is more agricultural products, so things like wheat, cotton, and livestock. So that's investments directly into those hard or soft commodities. Collectibles, this varies quite a bit. So it's really think of things like art, vintage vehicles, actually rare wines and spirits, memorabilia, luxury goods, and even antiques. And then the last one is structured products. So this is your pre-packaged investment strategies, which typically are derivatives based, or they have some form of other investment instrument that is utilized within the strategy. But underneath those investment instruments is actually an underlying asset. So it could be your traditional investments like your equities or your bonds or debt securities or currencies. So it's a little bit more utilizing a whole range of different investment uh, uh, assets in that portfolio. And so why use alternatives in investment portfolios? So investors typically use alternatives to really improve the diversification in portfolios outside of your traditional investments. So, we ran through the different types of alternative assets beyond your equities, bonds, and cash. It reduces the reliance on share market returns. As I mentioned, alternatives typically generate their returns by other factors other than what's happening in investment markets. It can also provide access to income beyond bonds and cash, which we'll touch on particularly in the private credit or private debt side, where you can generate alternative sources of income from these investments. You can also capture long-term growth opportunities, particularly as I mentioned in private equity, where you might get access to companies that are not available publicly and are experiencing significant levels of growth. And the last one is it can potentially smooth portfolio volatility, as I mentioned, because alternatives may not be daily priced. You won't see those rapid changes in the valuation of the underlying assets, which also means the price of the underlying assets and portfolio won't be as volatile. And so running through obviously why we use them, just running through what are the risks with alternative investments, because there are a few. The first one being liquidity. This is probably one of the key differences between traditional and your alternative investments. So investments may be a little bit more difficult to sell if you really need the cash really quickly. As I mentioned, a lot of these investments might not have daily pricing, so it may take a bit longer for you to get access to your invested capital when you need it. Oh, sorry. Complexity. Some of these structures and strategies can be hard to understand, particularly as we went along that chain, particularly your structured products. They might be a little bit more complex in terms of the strategy and structure. Evaluation risk. It may not be daily priced, as I previously mentioned. Time horizon risk is another one. Capital may be locked away for a few years. You may not be able to access your funds, for example, for 5 or 7 years. So this is obviously your investment horizon is very important when looking at alternative investments. Another one is manager risk. There is just like your normal managed fund. When we're looking at managers, there's a whole range of different managers out there. So really making sure that we're looking at managers that have the skill and discipline in this area. And so how is APT looking at alternatives? At APT, we really evaluate alternatives the same disciplined, evidence-based that we apply to all our asset classes. So, this is your traditional investments like your equities, bonds, and cash in your managed funds. This includes, we assess the risk-adjusted returns, aligning the portfolio with the objectives that we're trying to achieve, and how each investment fits in within the broader strategy or within each client's portfolio. So alternatives can play a useful role in portfolios when they're used to complement traditional assets rather than being a replacement for shares and bonds. And so that's how we think about alternatives. We don't want to see a portfolio entirely made up of alternatives. As I mentioned at the start of the webinar, alternatives are a really good diversifier in investment portfolios. So we really want to blend them with existing traditional investment. Used selectively, as I mentioned, they're not a replacement for shares and bonds. Alternatives may not be suitable for every investor or every portfolio. A lot of them do have lower liquidity. Meaningful capital can be tied up for extended periods. And so this can be appropriate for investors with longer term horizons and have sufficient liquidity. They don't need the funds straight away, but it can be limiting for those who do need access to funds at short notice. Importantly, alternatives do not guarantee better returns. In periods where public markets perform strongly, private and alternative assets may lag their public counterparts, especially after fees. So the role they play should be assessed in the context of the overall portfolio objectives, rather than looking at how each alternative has performed. Illiquidity is another factor we consider when looking at alternatives. It's one of the most significant risks associated with alternative investments. Lockup periods, redemption restrictions, and longer investment horizons require careful planning and clear expectations. Valuation and transparency, as I mentioned, really looking at how these assets are valued and how frequently is important, as well as looking at the fees and costs and structures of each strategy that we're looking at. Complexity is another consideration. So alternative strategies can be harder to understand. As I mentioned, they can be less transparent and difficult to value than listed investments. This makes the due diligence of each strategy and ongoing monitoring particularly important. As I just mentioned, looking at how the assets are valued, the methodology, the frequency, assessing the manager, how long have they been running the portfolio for, what's the team size, how long have the team been together, etc. And then the last one is position sizing matters. Even when alternatives are appropriate, allocations should be measured and aligned with our clients' goals, time horizon, and tolerance for illiquidity. So expectations also need to be realistic. Alternatives are not designed to eliminate risk or deliver consistent outperformance, but we do think that they do provide, a lot of benefits to a diversified portfolio. And with that, that's just an outline of alternatives and how we're thinking about alternatives. And in the next part, we'll do a Q&A session with our guest today. And so if you have any questions, as I mentioned along the way, we want to keep it really interactive. And what we'll be focusing on is on one of the sleeves, which is private debt. And today, as I mentioned, we have Carl McCarthy joining us today, who is from PIMCO. He is an executive vice president and he's the head of alternative credit in Asia out of PIMCO's Singapore office. So prior to PIMCO in 2011, when he joined in 2011, he was a senior financial analyst at the Bank of America, supporting long-short leverage the loan trading desk. And before then, he was also in the Bank of America's internal pension plan and retirement team. So welcome, Kyle.
Yeah, thanks so much, Sarah. Good to be here. Good to see everyone.
Now, just to start off in this section, did you just want to give a background on PIMCO and I guess your role at PIMCO?
Yeah, happy to do that. So I'm sure many of you are quite familiar with PIMCO on the public side of our business. Again, large fixed income manager focused, primarily across public and private markets. Maybe a little bit, less familiar with us on the private side of our business. We do manage about 200 billion in alternatives. And Sarah just gave a great overview of, the various markets. I would say our platform really focuses on three areas, private credit being one of the primary ones, but we also have a very large hedge fund as well as real estate, both equity and debt platform as well. That sums up to that total 200 billion. On the private credit side, we've got, about 100 or so portfolio managers that are just dedicated to the private markets. So again, highly focused on, sourcing, originating, underwriting all the opportunities. And I would say what really differentiates the PIMCO platform perhaps from, many others out there is that we really approach the private credit markets through the lens of fixed income. So again, leaning into our history, our pedigree, everything that all of you probably know, PIMCO quite well for, we're applying that investment philosophy to the private side of our business as well. So what that means is a little bit less focus on, more of the private equity type opportunity set and even corporate direct lending, which we'll talk about more today as being a direct corollary to that, and more focused on hard asset type lending. So things like property or commercial real estate debt, asset-backed finance, which I'm sure we'll talk more about today as well, kind of lending into the real economy, things like mortgages and consumer loans and aircraft leasing, auto loans, et cetera. Again, all these areas are direct parallels to what we see within public fixed income as well. So leaning into PIMCO's strengths and our long, 50 plus year history and investing in those areas and now applying that to the private side of our business as well. So it's been operating for, well over a decade. And again, large team, very important, focus for us internally, and, top tier manager globally as you look at the peer set.
Thanks, Carl. And looking at private credit, how does PIMCO define private credit? And do you just want to run through, the different types of private credit?
Yeah, and look, Sarah, I think you gave a great, kind of early intro and overview before, just in terms of like how to define private credit, what it is. But maybe just, quick recap there is it's really any form of lending that's outside of the banking industry, right? So where you don't have a bank essentially as an intermediary, where they're creating, credit securities or bonds that are then, sold broadly to investors. Essentially what's happening is you have a private lender or a non-bank lender stepping in and disintermediating the bank. So the bank is kind of carved out of the process, and that lender works directly with the borrower. So I think a simple example here is you have maybe a private equity firm who is buying a company, right? Sarah, you mentioned like the LBO market or the leverage buyout market, and they want to borrow in order to, essentially, finance that merger and acquisition activity or that LBO. They would go to a, direct lender, a private lender such as ourselves, and just work directly with us in terms of creating, what is essentially a private loan, fully customized, fully bespoke, specifically for their needs, and then basically bypassing, the banking system, right? So that's a good example of kind of, what a private loan would look like. Key characteristics I thought you covered very well before, right? These tend to be illiquid, right? Because they are just more of a one-on-one, bilateral loan with one lender, one borrower, and they tend to be very customized. There's not a lot of price discovery, quote unquote, as we call it, right? So there's not a lot of trading of these assets. They tend to just be buy and hold. And that illiquidity results in higher yields. So essentially, us as lenders or as investors, you all investing in the private credit space, want additional compensation for basically holding an illiquid asset that may be difficult to sell. And so what that results in is essentially premium yields or yields that are typically higher than what you can achieve within the public markets, but with the trade-off being that it's illiquid. So again, I think that's a key consideration. But again, as we think about kind of the use case for private credit in your portfolios, and we'll talk more about this as well, that yield enhancement kind of objective is one of the core characteristics of the space. The other point you mentioned, Sarah, is just like, how do we define it more broadly and kind of how the space has evolved a little bit. So, I gave a very simple example of just a private corporate loan. But what I would say is, private credit is actually a very broad universe and spans a couple of different subsectors. And if I could, maybe just to summarize three kind of main categories, you have private corporate lending, which is kind of the example I gave, right? So like lending to a private company or, a private equity sponsor who is, engaging in an LBO, essentially a private corporate loan to a corporation. And they tend to be more on the small to mid-size kind of area of the market. Second bucket would be commercial real estate or property lending, right? So this would be a loan that backs maybe a development project or even a building that is currently, standing, but just finances, that property. So it could be an office tower, it could be an apartment complex. Sorry, it could be an industrial property. Any of those property types, would qualify under the property bucket. And then third is this asset-backed finance category, or ABF, or ABL, asset-backed lending. They all kind of mean the same thing, but it's really everything else. So if it's not corporate, if it's not property related, but tends to be lending into the real economy. So again, think like consumer credit, residential mortgages. These tend to be pooled together. Aircraft leasing is another good example. Equipment finance, student loans as well in terms of financing higher education, music royalties. There's a very broad and diverse category there as well that I would say is very separate and distinct from the corporate and the property buckets as well. And so again, think of private credit very broadly as, any form of lending. And again, there's parallels to the public side, right? There's equivalent markets within public fixed income and kind of all these areas that I mentioned, but we've seen this continued trend towards more private, bespoke, illiquid type lending as well, and hence, all these markets are now opportunities for investors to approach as well.
And you touched on just then that borrowers are bypassing the banks now and going towards private credit. Why do you think more borrowers are choosing private credit over your traditional banks?
Yeah, it's a great question. So I would say it's two things, right? It's both demand and supply of capital. So on the demand side, which I think Sarah is where you're going with the question in terms of like why would a borrower choose to go, private versus public? And that rationale is really around the flexibility, the customization, and the bespoke nature of the financings. The problem is when you go to a bank for, a more normal, let's say fixed income or a bond issuance, it has to fit a very narrow box in terms of the specifications, the type of loan. It's really like well defined and a very kind of narrow optionality in terms of the type of financing that you can obtain. In a lot of cases, again, that works out just fine, and that's why a lot of borrowers still approach the public markets. And of course, there's trillions of debt outstanding on the public side. But you're right, there has been kind of the shift towards wanting something that's a bit more bespoke, more flexible, and that's what the private market can offer. So I think that's one of the key points. The other benefit is just kind of the speed to market, and as we call it, certainty of execution. So certainty of pricing of that debt as well. If you're a borrower and you go to a bank, essentially what a bank is doing is they're really not holding on to that debt themselves any longer. They're typically spreading that risk out to investors, or said another way, they're syndicating it. So there's really a number of investors that are involved, and that complicates the negotiation process. Where with a private loan, if you're just bypassing the banking system and going direct to a single lender, you're only negotiating with one party. And that one party is very sophisticated. Again, it's the PIMCOs of the world. We can very quickly put together, a loan documentation, credit agreement, specify all the terms, customize it, and be very quick to market with basically a guaranteed rate, which is, offers significant benefits to the borrower as well, depending on, again, the speed of execution that they're looking for. So again, it's flexibility, it's customization, it's the speed of execution too, in terms of the borrowings that are clear benefits to the borrower, and is also why they're typically willing to pay, call it anywhere from 1 to 2 percentage points above their cost that they would get in the public markets, right? So they're kind of paying a premium, right, or a higher debt cost for that additional optionality. Now, the other side of the coin as well, which I think is very important, and kind of why this market, kind of grew up and was created to begin with, is really more of the supply of capital side of things, which is that banks, particularly in the US and in Europe, are shifting much more towards a capital light model. And that's because of just regulatory changes, right? So following the global financial crisis in 2008, regulators stepped in and they said, we need to make the banking system safer. You have to hold more liquidity. You have to hold more collateral. You have to have less leverage. And so that basically restricted, how much banks were kind of willing and able to lend. And I'm not saying that they're not lending anymore. They're still, obviously very active within the space. but they're doing so in a way where they're holding less of this credit on balance sheet. And so again, they're looking to syndicate it out or sell it to investors, or in some cases, they did completely just kind of leave certain markets, right? And that void basically allowed private lenders to step in and basically, take the place of the banks in a lot of cases. So again, it's a little bit of a two-part story, right? It's a regulatory driven kind of structural change in the market where banks are being forced to be to retrench a bit, right, and kind of reduce balance sheet, pull back in terms of their lending activity, and be more capital efficient. And then on the other hand, you have borrowers and companies that are staying private longer, but borrowers that are looking for that kind of customization, bespoke certainty of timing and execution, and kind of those two big trends combined is what has driven, pretty significant growth within the private credit space.
Great. And, we just touched on why borrowers have been attracted to private credit. I think looking on the other side, in terms of investors, can you just run through, what are the main drivers of private credit returns? And they've often been seen as a alternative to your traditional fixed income. How should investors be thinking about private credit in a diversified portfolio?
Yeah, great question. So I would frame it very simply as it's a yield enhancer and a diversifier. Like that's the way that investors should think about it. It should not necessarily replace, high quality core fixed income, which is really meant to be, liquid and a ballast to your portfolios that, when equity markets sell off, typically what you would see is, that's because of growth slowing. So rates are usually coming down and therefore bond prices are increasing. And it's this nice, again, ballast kind of diversifier to your portfolio that is liquid, that is high quality and very much loss remote. So again, I would view fixed income and kind of your more traditional like 60/40 portfolio as still offering significant value from that perspective. But I agree with how you framed it earlier, Sarah, and that you kind of said, you wouldn't want 100% of your portfolio in alternatives, but carving out a portion, right, of that 60/40, and probably partially from fixed income, partially from equities, and investing in alternative investments can really enhance a portfolio overall, both from a risk and a return perspective, right? Because you have higher return potential in many cases and the diversification benefits. And that's very much the case with private credit, right? So as I think about the key benefits and the return drivers here, again, think of this as private fixed income, right? So this is an income driven alternative. We're not relying upon, price appreciation or value creation like you would in, say, venture capital or in private equity. This is really about, originating high quality credit that is illiquid, holding that over time and just earning that yield and steady income, right? That's really what this is about. But because it's illiquid, and as I mentioned earlier, that investors require essentially a premium, right? Because I have less flexibility with holding that in my portfolio. I don't have the ability to just sell it tomorrow at kind of current value. It may take some time, or I may have to sell it at a much lower price because of its illiquidity. I want to be compensated for that risk, right? And what that tends to translate into, as we look back historically, is that you get enhanced yields of, call it, 1% to 2% or more within the private credit space. And so again, if you look back over the past 3 to 5 years, where the space has really grown quite meaningfully, returns have been really strong. High single digit, low double digits. I think given where yields are currently within private credit, high single digits is a very realistic return expectation going forward. So call it somewhere in like the 7 to 10% range. Again, given where interest rates are today, given where coupons and overall yields are, that of course will fluctuate, right, in terms of market conditions and things can change quite rapidly, as we've seen over the past few weeks, right? The macro environment is constantly evolving, but I think that's a pretty healthy and good range to kind of keep in mind as representative, right, of what to expect. So again, the way that I would think about this in summary is, this is a yield enhancement feature for your portfolio, not to replace fixed income, but if you're looking for, high single digit, call it almost equity-like returns, but with more of a debt-like profile, meaning, you're top of the capital structure, typically lending in a senior secured manner where you have collateral as support. That's a pretty well protected, lower volatility option that gives you that enhanced return profile. The key trade-off and thing to keep in mind is that these strategies are less liquid, right? And so that's the sacrifice that investors need to make, and hence why 100% of your portfolio should not be in alternatives or even in private credit, for example, but a portion can make a ton of sense, right? Because it does really provide that return enhancement from the steady income that you're receiving. In many cases, that's paid out monthly. So it's really about that consistent income feature that's at a premium to what you can get within public markets.
Yeah, and so when we're looking at public versus private, I think you touched on it already. What does private credit solve um, that public doesn't? And I think you might have touched on it. Is it that enhanced income that private credit is adding on top of public markets?
Yeah, I'd say that's the main one. And then again, as a secondary benefit, it's the downside protection that you get by being typically senior secured in the capital structure, right? So basically you're the first to be paid back. And in many cases you have some form of, tangible physical collateral that's securing the loans as well. So if you think about a mortgage, like you have a house that is basically backing, that loan, or aircraft leasing, you have an airplane, right? That you could of course take back and release if there was a credit problem. So there's a bit of downside mitigation that comes with it as well. And then, Sarah, the big point that you were hitting on as well across really all alternative, asset types is diversification, right? And so I think about private credit, it's giving you pretty unique access to opportunity sets that, again, by definition, are falling outside of the public markets that you as an investor wouldn't even be able to get access to unless you're investing in a private credit strategy, right? And again, I went through some of the examples, but you've got various, different borrower types, everything from, property owners to consumers to data center operators to corporations to, auto loans and music royalties. Like there's a lot of very diversifying cash flows that are incorporated within the space. So you have diversifying borrowers, diversifying collateral, diversifying cash flows that, again, in a broader portfolio context, can help smooth volatility over time, right? So again, it really not only enhances returns, but by adding it to your portfolio should also smooth volatility overall as well, because you're adding unique risk factors within the broader book.
Great. And you started touching on risks within private credit. What risks do you think investors often underestimate in private credit?
Yeah, so I think well, let me take a step back. So the key risks first, right? And then I'll say which ones I think are somewhat underestimated today. So again, the key risk to keep in mind is ultimately these are credit investments, right? And so we are, lending to borrowers. And so your main risk is that the borrower defaults, right? And so it's all about, credit selection, as we call it, or, asset selection, where we are lending to high quality borrowers that we think are low probability of default to begin with. But of course, we're not perfect. No one's perfect. So you're going to get things wrong over time. And it's all about how do you build in additional layers of protection, right? And so it's through the collateral, through other, forms of covenants and ways that you can build in investor protections where even when there is a default or a credit issue, that you recover as much as possible, right? But number one risk I would say is, let's just call it credit risk, right? Or default risk. And this is where manager selection is key. Of course, track records, history, ability to underwrite, use of data, all of that becomes incredibly important as you think about, who you're investing with and mitigating, the potential for capital impairment and losses there. I think the second risk, of course, is liquidity, as we've talked about, right? So that's what is getting you that additional yield or that additional return premium in this case. And so investors just need to budget for that, right? And so they need to be thinking about, again, what, relative to the size of my portfolio, how much liquidity am I willing to sacrifice in return for that higher return potential over time? So again, another key risk measure. And then the third one is a lot of these strategies also do utilize leverage, financing or gearing, however you want to call it. And so just keep that in mind as well. It's another tool for investment managers to essentially enhance yields over time. Again, these tend to be very high quality borrowers, and so they finance quite efficiently. And it's another way, again, that we can also just offer enhanced returns. Of course, you're increasing risk as well, but that's typically utilized within a portfolio. And again, it's just something for investors to keep in mind. I think in terms of the initial question, Sarah, on what is being underestimated, I would say two things really quickly. The first one is just in terms of the credit risk. I think we should all just keep in mind that, the past 10 years has been a very benign environment. So we really haven't seen a cycle play out. And we should just keep in mind that credit markets are cyclical, right? So at some point, there will be a default cycle that plays out, a more severe market downturn that is prolonged. And just we should expect again that there will be, defaults across the industry. And this is where you'll start to see some dispersion across managers and who was conservative, who was not. But we've kind of grown up in a world where, at least over the past decade or so, you've seen very, very little defaults because you haven't actually seen a cycle play out. So just one thing to keep in mind, right, is low volatility does not necessarily equal low risk, right? It just could mean that we've lived through a really stable and relatively benign period outside of just a few hiccups here and there. I think the other one is just around liquidity, and we can definitely talk more about this, but there's been a lot of growth in what they call, semi-liquid vehicles or kind of open-ended strategies that do allow investors to redeem from illiquid funds on, say, a quarterly basis with some restrictions. And just, to be careful with that, because again, there are limitations there, right? Semi-liquid doesn't necessarily mean fully liquid, right? It does mean that there are some restrictions that will be put in place because, again, the underlying assets here are illiquid loans, right? And so we want to be very careful and be fair to all investors within the fund, not have to force sell assets at the wrong time. And so you do put limitations or essentially gates around, how much liquidity you can provide to end investors. And so I think there's a little bit more of a spotlight on those terms today, but just on the liquidity side, I think again that should be top of mind for everyone and thinking through, how much to allocate to these markets because it does require a longer hold period, long-term investment mentality because of the illiquid profile of the underlying investments. But as long as
Yeah.
that's well understood, I think it can make, a ton of sense for investors.
Yeah, great. And I just want to expand on that liquidity piece. Liquidity is one of the key differences between public and private markets. And what we've seen over the last few months, your big private credit managers over in the US, Blue Owl, BlackRock, and recently Cliffwater, restricting redemptions on their private credit funds. How should investors think about lockups and redemption risk? And how does this affect portfolio construction?
Yeah, it's a very timely and topical question. As you said, it's been in the headlines quite a bit lately. And I think some of it is just a little bit of a lack of understanding, but also the press trying to, make a big story out of again, what I would say is like mischaracterizing to a large extent. First off, again, with all these strategies where they are kind of restricting, right, the amount of flows, that's by design, right? So again, that was always meant to be the case, and the managers are actually doing what they're supposed to do, right? So per the terms, right, they will limit redemptions to 5% per quarter, let's say, right, or 5 to 7%. It varies a little bit. And so, yeah, if they get 10 or 15% redemptions, they're going to prorate and essentially limit them back to, the stated 5 to 7%. And again, it's a feature. It's not a bug, right? This is basically protecting everyone else who's remaining within the fund to not be impacted by, forced sale of assets to raise liquidity to meet redemptions that could then hurt returns for everyone else that remains within the product, right? And so it provides basically the visibility and a pacing of raising liquidity that aligns much more with the liquidity of the actual loans and leases and mortgages and everything that are within these strategies. So I think that education component is important, and then what I think is getting lost a little bit within the press. Now, having said all that, what is driving the redemption activity, right, is some concerns around two things, right? Number one, it's credit quality within the funds themselves, right? And one of the things that you've seen, especially with the corporate direct lending oriented strategies, so again, the business development companies or BDCs, as they call them within the US, they focus predominantly on a very narrow, opportunity set within private credit, which is just corporate lending. And the problem is that a lot of that market over the past few years has concentrated in software. So it's anywhere from 25 to 30% is kind of the general estimate. And of course, there's a lot of risks now being priced in, given, the rapid progress in AI, that this market or these companies will be disrupted and potentially become obsolete very quickly. And hence major concerns around, well, what does this mean not only for my private equity portfolios, right, the private equity companies that own these companies, but also the private credit funds that have lent to these companies as well. So it's those concerns that are driving, I think, investors saying, okay, maybe the trade is over, maybe it's time to get out and redeem. Along with, I would say, the second point, which is concerns around just transparency and pricing, right? I think that a lot of industry players are still not necessarily actively marketing or marking their positions as much as they should be. And there's concerns that potentially the NAV is inflated, right? Or doesn't, truly reflect the current fair value. And this is where, again, firms like PIMCO and others who have been on the other end of the spectrum trying to be extremely transparent. You do see volatility on our NAVs. We do fair value price everything within our portfolios, and we're looking at the public markets essentially as a proxy, right? In terms of how to price the private assets, even if they're not trading, you can still look to very strong, representative proxies to give you a sense of what the fair value would be. And it's those concerns around, again, the opacity, questions on, what truly is the NAV. If I am questioning that and the transparency, then maybe I should just get out rather than wait for that manager to mark down the portfolio, right? So again, I do think that, between the credit quality concerns and then the related, NAV transparency are two, real structural issues that the market is going to have to continue to deal with and is what is driving the redemptions. But big picture, again, when redemptions occur, I actually think that the managers are doing the right thing in terms of adhering to the terms of the fund and just limiting, right, the overall amount of redemptions that could come out. And this just goes back to my comments earlier, right? For all of you as investors, just something to keep in mind, right? That there's the possibility to redeem, right, on a quarterly basis in many of these funds, but it doesn't necessarily guarantee that you can redeem 100%, right? So just make sure you're budgeting that as you think about, again, size of allocation and the amount of illiquidity risk that you want to take.
Yeah, and I might just touch on there for our clients, when I was touching on our due diligence process, this is exactly the types of things we're looking out for is, what percentage of the overall fund is available for that liquidity facility? How often is it made available to clients, whether it's quarterly, half yearly or yearly? And as Carl mentioned, the valuation, how often the underlying assets are valued in the portfolio, I think is really important when we're looking at all of these risks. But the other thing as well is when we meet with potential managers that we're going to introduce to clients, looking at the diversification of the other underlying investors as well is really key for us as well. Making sure there's not one big investor that may pose a risk for, if they suddenly redeem, that fills up that liquidity facility, that stops any further redemptions for other providers. So looking at the diversification, not only in the portfolio, but the diversification of investors in that particular fund, just to note, is something we also look at.
It's a very good
And
point.
just very topical as well that you just touched on that I might go to next is technology and AI. That's been a very big topic in all markets, actually, just both equity and private credit. We've seen particular AI and software really selling off in public equity markets. And just last week, we saw it on domestically, we saw Macquarie Capital reveal that their credit exposure to software loans was around 7.8 billion, of which 275 million could be written off if 10% of borrowers started to default. With the sell-off in technology stocks that we've seen in 2026, what impact has the technology sector had on private credit?
Yeah, very, very timely topic indeed. And look, I think it is driving, as I mentioned, some of the negative sentiment today because of the concentration that you do see within private credit. So just to give you a sense, like if you look at the high yield, the public, high yield bond market, software only makes up a few percentage points of the overall index. So it's a very small portion of companies overall that would be included. If you shift into the floating rate bank loan market, as they call it, or the broadly syndicated markets, again, this would be kind of the equivalent of private credit, but what the banks are still doing there, it's a bit higher. It's like 11, 12% of the overall market. But then when you go to private credit, as I mentioned earlier, it's about 25 to 30%. Now it's, not fully transparent, so these estimates are a little bit of a range. But it's a large portion of corporate direct lending portfolio. So again, I go back to my opening comments that, private credit is a very broad universe and there's multiple lanes to participate in. Corporate lending is, of course, one of them. And that's where we've seen the most growth over the past few years. It has performed well, but again, it hasn't really been tested in the default cycle. It is where we see the most competition. It's where spreads have compressed the most. There's a lot of dry powder. And it's also where credit is deteriorating, right? So again, there are concerns around defaults. There's been a number of headlines over the past few months. And of course, the concerns around software and, AI adjacent, let's call it, type technology companies offering software type services are all in focus right now in terms of just longer term what's going to happen. And none of us have the crystal ball in terms of how this is all going to play out. And of course, it's progressing so rapidly that it's very difficult. But that's what's also again encouraging investors to say, well, I'm not even going to wait around to see how this plays out. I would rather just redeem. And this is where again I think more narrowly focused strategies may struggle because investors will see that concentration and they will see the cyclicality start to play out, and they'll view it as more of a trade as opposed to a structural allocation. And so one of the things that we've been very focused on in our platform is not just providing access to a very singular narrow opportunity set, but really being broad and diversified, right? And having that investment flexibility to say, yeah, we actually never liked software and the amount of leverage and the lack of interest coverage that we were seeing. So let's avoid that opportunity so that we're not forced to deploy capital into any given area. We have all these other opportunities that we can focus on instead that we view as better risk reward, offers better returns and downside protection to investors, and should be more resilient, right, as we head into a downturn. And that's things like mortgages and high quality consumer credit and aircraft leasing I've mentioned a few times. So that flexibility and the breadth, and I think the diversification is going to be a trend in the phase two, if I could call it that, 2.0 of private credit, is again less focus on getting access to just a very specific narrow opportunity like corporate direct lending, but looking at private credit similar to you all probably look at your bond portfolios, right? Or public fixed income, which is highly diversified, to look across the whole universe and invest with someone that has the capabilities and the strengths to, do that well. So that's how I would approach it. The last thing I would say is just there's a lot of good research coming out from a number of the banks, right, that are pointing to this kind of concentration risk within the corporate direct lending side. I think even just overnight or yesterday, Morgan Stanley released a report where they're forecasting that defaults within corporate direct lending will probably rise from about 4 to 5% currently to about 8% over the next year or two. And that's almost all driven by, again, distress that they expect to play out within the software and technology space. Now, those defaults over the past 12 months have only been about 2 to 3%, to give you a sense, within software in particular. So the fact that the whole market is going to shift from a 5 to an 8, largely driven by that, again, it does mean that they are expecting quite a bit of disruption. So again, I go back to my comments earlier and almost, Sarah, to your question on what risks are being underappreciated. And I think it's this, low vol, right? Low volatility does not necessarily mean low risk. Like there is still risk that exists within this market. And that the more and more that we see some of these headlines and again, concerns around software, I do think more and more of that will come into the spotlight, into the forefront. And just investors should be aware that, it is relatively normal though, right? Again, these are in many cases semi-risky loans. You're getting paid a high premium and a high yield, to compensate you for that. But there will be defaults, there will be credit cycles over time. It's just we haven't seen one in such a while that we've kind of been conditioned to think that it's going to just be low volatility for forever. But again, I think that investors should be approaching this just thinking more broadly about private credit, right? Invest in complementary areas, invest with someone that has the flexibility to look across different markets where you're not pinned into being forced to invest into corporate loans and or software, that you can avoid it and focus on other areas that we think are much safer is the bottom line.
Great. And you touched on obviously that we haven't seen a sort of a default cycle in a long time. And what we've seen a lot of focus on and seeing increasing talk around is payment in kind. Can you just run through what payment in kind is for private credit? And is it a prudent structuring tool for private credit, or is it a warning sign of borrower stress?
Yeah, the short answer is it could be both, right? So payment in kind or PIK as they call it, PIK, is a nuanced term within kind of the corporate direct lending space, where essentially what it means is a loan where instead of paying current interest out as like a cash coupon over time, the interest is just added to the balance of the loan. So it helps a lot from a cash flow perspective for certain borrowers where let's say they're pretty cash strapped, they don't actually have to pay an ongoing, interest cash payment. Instead, it's just kind of added to my bill, right? Like it gets added to the balance of the loan, but it does mean that your LVR or your LTV, your loan to value as we call it, is increasing over time, right? So it's creating more of an event risk on the back end because basically the debt pile continues to rise over time. Sarah, I think you framed it very well in that it can be an effective tool in some cases. It can also be a warning sign, right? So we kind of frame it as like there's good pick and there's bad pick. The good payment in kind or the good pick is when this was structured, when a loan was structured that way from the onset. So from the very beginning, right? So again, you tend to see this with companies that, tend to be like extremely, high growth. They may have, long-term contracts where they have a lot of revenue visibility. And in many cases, as long as this is a very, small loan relative to their overall balance sheet, it can make a ton of sense to set something up that is more payment in kind based so they can grow into that debt over time. And then you can switch into more of a current pay, cash pay type structure, which is always preferred, right? Over PIK. And with those structures set up front, you can also build in a lot of other investor protections, right? So oftentimes you can negotiate, equity warrants and potential upside participation. You can build in additional cash sweeps and again ensure that you have a really low LTV. There's other covenants that you can then leverage and negotiate because you're kind of accommodating the lack of cash payments. But I would say this is a very small cohort, right? Again, like this is not the preferred approach. You should use this very selectively only with borrowers where this makes sense, but that's the good kind, right? And again, it can work out very, very well for companies where this fits their balance sheet and their growth profile. The bad kind is when you see these kind of PIK structures be the result of a modification, meaning that the loan was initially a current cash pay, but the company is now facing stress. And the only option is to kind of what they call extend and pretend, basically modify the loan and say, okay, well, you don't actually have to, we're not going to call it a default, but you're not going to pay me interest anymore. I'm just going to add it to the balance of your loan. Clearly, right, that is a warning sign and a sign that the company is going through challenges. And if that happened in the public markets, it would qualify as a quote unquote default, right? So this is where there's kind of a shadow default rate as well on the private side with a lot of these modifications that can hide kind of the true underlying stress within the market. But firms are getting better and better. Again, we as an industry, I think, need to be more transparent about these things. And a lot of the funds in the US now are required to report, the percentage of their portfolio that is PIK. And so you can track how that percentage is evolving over time. Unfortunately, again, given all my comments earlier, we are seeing that trend increase within many of these funds. And so again, it's another sign that again, we're heading into the later stages of the cycle, especially on corporate direct lending, where we could actually see a bit more stress dislocation continue to play out. So it's a nuanced discussion. I hope that helps. But it is an important risk factor, Sarah, that you mentioned that we, as investors should be tracking carefully across these funds, but very much focused on the corporate side. It's not really present in property debt or in the asset-backed markets that we tend to focus on.
Yeah, great. And we're coming up to time. So just final question. What do you think is the most compelling opportunities in private credit at the moment?
Yeah. So, and again, thank you all for the time today. I hope this has been helpful and happy to come back anytime and discuss any of these topics in more detail. I think and thank you to the app team as well for hosting. I would say, big picture, where we're finding opportunity today is in those hard asset backed type opportunities. So again, if you look at the dynamics at play, where we're seeing a bit of stress build and where there's still heightened competition and frankly, relative value is just not that compelling, is in that corporate direct lending space that I do think is going to start to go through at least a mini cycle, and we'll see how prolonged, this will become. Where things are still quite attractive is in property debt and in asset-backed finance. So again, financing into the real economy, everything from, residential mortgages in US and Europe. We're even seeing opportunities locally in Australia as well in terms of consumer and mortgage credit. And of course, property related debt, aircraft leasing, digital finance, as we think about, the need for the growth in data centers and all the infrastructure required around that as well, the powering of them too. These are areas that I think we're quite excited about. We're still seeing, pretty strong value in, and where we think there's a lot less competition, higher barriers to entry, which is what's keeping that relative value a lot more attractive. So I think bottom line, encourage all of you to kind of define private credit very broadly. I think historically there's been a bias towards private credit equals corporate direct lending, and maybe that was the case, 10 years ago. But a big evolution of the space is that it's really now encompassing, the entire universe of credit, everything from corporate to property to asset backed. And it's really those non-corporate areas where we're seeing most of the value today.
Great. Thank you, Kyle, again for joining us today. And for our clients that are on the line, or clients that might be watching the recording, if you have any further questions, please send them through to your advisor. We'll be more than happy to answer those queries. I'll hand it over back to Tiffany.
Thank you very much, Kyle and Sarah, for sharing this really fascinating discussion today. You didn't only touch on the technical aspects, but also warning signs and behavior of investors as well. So that's going to be very thought-provoking for a lot of our listeners today. And thank you everyone for coming along to today's event. We place a lot of value on financial education, so we're always delighted to have this platform to share our knowledge. As Sarah said, you are always welcome to contact us for any other questions, but a reminder that this recording from today's webinar will be available to you via email shortly. If you've learned something today that you think will benefit a friend or family member, please feel free to share this with them. That's all for today. We look forward to hosting you at our next event, and we'll see you then.
Thank you.